NVIDIA dropped 1.6%. Its Moat scores 78 out of 100. High durability. Wall Street panics over brief price noise while NVIDIA defends a massive 74.1% gross margin. That elite profitability stems directly from unmatched hardware dominance paired with deep software lock-in. The lab teardown reveals how this integrated architectural stack preserves structural market power. What operating evidence matters most for NVIDIA Corporation? The primary pillar of NVIDIA's persistent competitive moat sits at the intersection of hardware dominance and software lock-in. And another question, what could weaken NVIDIA Corporation's moat durability? The lab assigns NVIDIA a moat durability score of 78 out of 100, a direct measurement of structural moat strength and execution durability, not a trade recommendation or valuation signal. Walk the AI stack, and NVIDIA sits as a Tier 1 bottleneck, controlling AI accelerator GPU plus CUDA software stack. The moat here is software ecosystem, and it should hold for long. Blackwell architecture in full production with high demand, but supply constraints persist via TSMC co-cell packaging bottlenecks. Hyperscaler CapEx remains elevated through late 2025. The one force that could crack it: hyperscaler custom ASICs, Google TPU, Amazon Trainium, Meta MTA, AMD ROCm closing the 18-month gap. NVIDIA trades down 1.59% at $209.66 despite delivering a staggering $96.22 billion in quarterly revenue. Wall Street is confronting a growth ceiling debate, even after NVIDIA posted $89.0 billion in quarterly data center sales. The market is no longer asking whether NVIDIA can beat earnings. It just proved it can, beating estimates by a notable margin with a $2.46 GAAP EPS print. Instead, capital is pricing in the terrifying reality of peak cycle infrastructure spending. With a massive market cap, the valuation reflects a market torn between unprecedented execution and hyperscaler digestion risk. Big tech is deploying hundreds of billions in annual CapEx. Yet traders pull back on fears that software application revenue cannot keep pace with hardware deployments. The 30-day relative strength against tech benchmarks remains positive, but momentum has cooled. The core market question is simple. Does physical engineering justify this multi-trillion-dollar valuation, or are cloud providers ordered double-booking their way into a wall? The market sees a valuation debate, but silicon reality is governed entirely by packaging bottlenecks and thermal limits. A single structural microvoid across that substrate ruins the entire multi-die module. System scaling now hits a physical thermal wall. The GB200 NVL72 rack integrates many Blackwell GPUs and many Grace CPUs into one system, drawing significant power. Air cooling fails entirely at this power density. Direct-to-chip liquid cooling loops are mandatory to prevent severe thermal throttling. Compute throughput is no longer limited by raw flops. The true bottleneck is interconnect latency and memory bandwidth. Blackwell delivers 8 terabytes per second of HBM3E memory bandwidth, while NVLink 5 provides substantial bidirectional bandwidth per GPU. That mesh allows many GPUs to function as a single unified processor. Competitors cannot bridge this physical gap with raw compute alone. Custom ASICs like Amazon Trainium 2 or Google TPU v5p lower total cost for static workloads. However, they fail to match Blackwell's dynamic compiler efficiency on unoptimized models. Recent ISA-level audits on Blackwell Ultra prove that INT8 tensor execution units require saturated memory bandwidth to peak. The engineering verdict is unambiguous. Until packaging capacity doubles, physical hardware constraints will dictate the ceiling on revenue. Quarterly financials showing modest revenue momentum for NVIDIA. Tight monetary policy usually kills CapEx. Not in silicon. The Federal Reserve maintains rates at 3.63%. Annual consumer inflation sits at 0.6%, while national unemployment holds at 4.1%. Meanwhile, the 10-year Treasury yield trades at 4.64%. The yield spread stands at plus 0.47%. This signals higher borrowing costs across enterprise credit markets. Elevated capital costs directly impact hyperscaler CapEx. the cash capital expenditures companies allocate to buy physical hardware assets. Building gigawatt-scale data centers requires immense debt financing and substantial corporate cash reserves. When long-term yields rise, debt servicing grows expensive, squeezing corporate balance sheets and operating margins. Despite elevated interest rates, Calsure prediction markets price U.S. recession risk at just 6.2%. The broader economy is absorbing tight monetary policy without tipping into immediate contraction. We trace this monetary reality directly into underlying silicon packaging supply chains. TSMC's July monthly revenue surged 44.7% year-over-year to a record high in new Taiwan dollars. That represents approximately billions of US dollars in single-month foundry sales. Foundry output grew 5.6% month-over-month, proving that core accelerator production remains unconstrained by interest rates. Silicon keeps accelerating. Macro policy creates borrowing friction, but compute demand is surging past financial barriers. Government regulatory decisions are adding friction to international hardware logistics. A renewed trade war with Canada highlights rising protectionist trade tariffs across Western supply chains. Trade tariffs raise cross-border component procurement costs and complicate complex international hardware assembly lines. Simultaneously, incoming Federal Reserve leadership under Kevin Warsh faces intense scrutiny over interest rate trajectory. Uncertainty around future rate cuts forces executive teams to evaluate multi-year capital commitments. Wall Street fears tight monetary policy will compress technology hardware spending. The lab sees an infrastructure wave that continues outrunning macro policy friction. Geopolitical dynamics pose a far more immediate physical threat to global silicon availability. The primary systemic vulnerability sits in the geographic concentration of advanced packaging lines in Taiwan. A single fab, the specialized manufacturing facility where silicon wafers become microchips, holds structural leverage over global output. Any escalation in Taiwan Strait tension risks interrupting the global supply of advanced AI accelerators. U.S. national security policy relies on stringent export controls to restrict high-end silicon sales to foreign rivals. These geopolitical trade limits force hardware vendors to design lower-performing regional chips to maintain regional compliance. Lower performance specifications depress chip margins and fragment unified architecture deployment across global cloud networks. Conflict is driving capital. International conflict and tech sanctions are inadvertently driving unprecedented public investment into localized hardware builds. Social and political dynamics are simultaneously reshaping how governments view computing power. Nations increasingly define artificial intelligence infrastructure as core national security and economic sovereignty assets. This drives the rapid expansion of sovereign AI, a nation-state strategy to build native computing infrastructure within its own borders. Governments across Europe, Asia, and the Middle East are funding localized data centers to avoid foreign technological dependency. Sovereign AI budgets create an immune system against private enterprise capital budget cuts or interest rate spikes. Concurrently, public scrutiny regarding data center energy consumption is creating local environmental regulatory friction. Power grid capacity limits in major metro regions are forcing cloud providers to build in remote locations. Local governments are demanding higher efficiency standards and liquid cooling infrastructure to protect regional electrical grids. Political backlash against tech energy usage increases initial facility construction costs for hardware operators. However, power density constraints only increase the value of ultra-efficient, highly dense computing architectures. While media headlines focus on trade wars and political debate, state-sponsored buyers continue securing hardware capacity. Macro policy creates operational hurdles, but geopolitical survival guarantees sovereign capital flows into physical hardware. At the lab, we trace every dollar of big tech capital expenditure straight back to silicon. Total hyperscaler capex hit $110.8 billion last quarter, driven by $44.9 billion from GCP, $35.8 billion from Azure, and $30.1 billion from Meta. This massive infrastructure spend flows directly into NVIDIA's top line, driving Q2 revenue to $96.2 billion, up 106% year-over-year, with data center representing $89.0 billion of that demand. We see hyperscaler capital remaining fully locked into NVIDIA's computing ecosystem. NVIDIA reported earnings per share of $2.22, beating the Wall Street estimate of $2.13 by 4.3%. A solid beat that signals strong execution. Looking at the quarterly track record, we see a textbook pattern of disciplined guidance strategy at NVIDIA. Across the past 4 quarters, management extended a 4-quarter beat streak, pushing surprise margins from 2% in late fiscal 2026 up to 4.3% in the latest quarter with an EPS of $2.22. At the lab, our data confirms management routinely sets conservative targets to maintain upside momentum as quarterly revenue scales past $96 billion. NVIDIA Compute is trading below its 20-day average at 200. Jensen Huang opened the second quarter fiscal 2027 earnings release with a masterclass in corporate messaging. AI has reached its inflection point. It's doing useful work. Its tokens are productive and profitable. Now, compute is revenue. Jensen Huang, founder and CEO, Q2 FY27 earnings release. 4 words engineered to redefine Wall Street's mental model. Compute is revenue. That phrase is crafted to convince analysts that $96.2 billion in quarterly revenue represents a permanent software-like tax on global computing, rather than a capital-intensive hardware cycle. The PR strategy is transparent. Anchor the narrative on hypergrowth and absolute pricing power, so investors ignore the structural liabilities accumulating underneath. While management preaches continuous acceleration, executive behavior reveals a strikingly different operational signal. Director Mark A. Having written executive communications for tech firms, I know the drill. Press releases frame the public dream, but SEC Form 4 filings capture cold physical reality. Smart money positioning reflects similar caution into the print. Cathie Wood's ARKK fund trimmed 16,872 shares right before earnings dropped. Meanwhile, FINRA short volume rose to 39.5% of total volume against a 36.5% baseline, indicating market makers and hedge funds are actively hedging against an overextended cycle. When insider selling aligns with smart money distribution, the PR spin breaks down. NVIDIA's purchase, supply, and capacity commitments surged from $119 billion to a staggering $279 billion. To secure supply for future chips, NVIDIA is committing financial capital at an unprecedented scale. NVIDIA disclosed that under new agreements with AI cloud providers, if those clouds fail to sell their committed AI compute capacity to end customers, NVIDIA has legally agreed to buy back that unsold capacity itself. Furthermore, NVIDIA entered into financial guarantees for leases at the port's technology campus tied to OpenAI and SB Energy, exposing the company to substantial long-term obligations if OpenAI fails to meet its commitments. In short, NVIDIA is structurally underwriting its own customer demand. This structural shift explains the linguistic divergence between the press release and the SEC filing. What management says publicly is that compute is revenue and demand is unlimited. What the lab hears in the regulatory filings is that NVIDIA is acting as its own buyer of last resort to maintain the appearance of hypergrowth. If capacity commitments plateau while buyback liabilities begin triggering, the bull thesis breaks and hardware digestion begins. The momentum breakdown for NVIDIA. RSI sits at 39, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The primary pillar of NVIDIA's persistent competitive moat sits at the intersection of hardware dominance and software lock-in. CUDA, Compute Unified Device Architecture, NVIDIA's proprietary software layer that translates raw code into parallel GPU instructions, creates a software network effect that keeps over 5 million developers anchored to its architecture. Translating millions of lines of CUDA code to open-source software requires immense compilation latency and engineering expense. Delivering $89.0 billion in quarterly data center revenue at a 75% gross margin, the percentage of revenue remaining after direct manufacturing costs. proves its hardware pricing power remains absolute. Yet, this moat faces immediate physical and structural erosion that Wall Street ignores. Operating with 92.5% of total quarterly revenue concentrated in a single data center segment leaves cash flows hyperexposed to hyperscaler capital spending cycles. Manufacturing relies entirely on TSMC's packaging line for CoWoS, chip-on-wafer-on-substrate, the advanced packaging process that bridges logic dies with memory, where supply remains acutely bottlenecked. Meanwhile, strict export restrictions from the BS, Bureau of Industry and Security, the U.S. Trade Enforcement Board, force NVIDIA to sell lower-margin, detuned H20 chips in China to clients like Tencent and Alibaba. Simultaneously, major customers are actively deploying internal ASICs, application-specific integrated circuits, custom chips tailored for specific corporate workloads, including Google TPU, Amazon Trainium, and Meta MTIA to run inference without paying NVIDIA's margins. Here is the exact question that semiconductor engineers and former investor relations directors asked behind closed doors. Can NVIDIA maintain its 75% gross margin when cloud providers shift majority capital expenditure from initial large language model training to routine token inference? The lab's engineering reality check is uncompromising. Training requires massive parallel clusters where NVLink inter-GPU bandwidth is non-negotiable, but routine inference allows hyperscalers to utilize lower-cost custom silicon. To judge the structural integrity of this business, we track two distinct operational scenarios over the next 12 months. If NVIDIA successfully ramps its Blackwell architecture while holding gross margins above 73% during the manufacturing transition, it proves that proprietary software lock-in and system-level engineering override any threat from custom customer silicon. The single source data point that will distinguish these trajectories is the sequential gross margin trend in upcoming SEC quarterly filings. The lab assigns NVIDIA a Moat durability score of 78 out of 100, a direct measurement of structural moat strength and execution durability, not a trade recommendation or valuation signal. Software moat lock-in keeps NVIDIA firmly in command, but physical packaging walls and custom customer silicon are narrowing its operational buffer. Here's the macro picture shaping NVIDIA. Strict BS export controls limit high-end accelerator sales, forcing NVIDIA to ship restricted H20 chips to Chinese clients like Tencent and Alibaba. Meanwhile, total reliance on TSMC's Taiwan fabs leaves its supply chain acutely exposed to cross-strait geopolitical conflicts that U.S. CHIPS Act grants cannot quickly solve. Explosive demand for generative AI accelerators relies heavily on TSMC's CoWoS advanced packaging and high-bandwidth HBM3E memory to eliminate interconnect bottlenecks. NVIDIA is riding this wave. The lab places NVIDIA at the cycle peak as quarterly revenue scales to $96.2 billion and supply commitments balloon to $279 billion. While management frames this era as an unstoppable shift where compute directly converts to revenue, our engineering lens highlights tightening supply constraints, memory bottlenecks, and gross margins trimming to 74%. Over the next 2 quarters, we expect execution friction, specifically land, power, and co-packaged optics deployment, to supersede raw demand as the primary driver of stock performance. NVIDIA obliterates its semiconductor peer group on operational capability, anchored by a massive 74% gross margin. At the lab, we judge silicon moats by raw operational output. Let us run the head-to-head hardware benchmarks against the entire field. Look at advanced micro devices trading at $480.93, down 0.8% today. AMD logged a 140.2% year-to-date surge with revenue growth at plus 50.1%. However, AMD's 56% gross margin trails NVIDIA by a massive 18 percentage points. NVIDIA dominates AMD by pulling plus 85.2% revenue growth on top of far superior unit economics. Intel presents a vastly weaker structural reality at $88.24, down 1.9% today. Intel managed plus 25.4% revenue growth alongside a year-to-date gain of plus 93.5%. Yet Intel carries a weak 39% gross margin. That 39% figure reveals severe manufacturing yield drag when measured against NVIDIA's 74% benchmark. Then look at Qualcomm trading at $163.72, down 0.6% today. Qualcomm delivered a year-to-date gain of plus 16.2%. Qualcomm holds a lower valuation multiple, but its revenue growth shrank at minus 4%. Qualcomm's 54% gross margin cannot compete with NVIDIA's premium silicon pricing power. Wall Street loves to debate valuation multiples across the semiconductor sector. NVIDIA printed a high durability score of 78 in our lab metrics. Which engineering constraint most threatens NVIDIA Corporation's moat? Give us your evidence. As a quick reminder, everything we publish at Denver Stock Lab is strictly for educational purposes and is not financial advice. Past performance doesn't guarantee future results. You should always do your own independent research and risk evaluation before placing any capital in the market. Subscribe so you don't miss Thursday's deep dive. We're tearing down CrowdStrike. If you want our full breakdown on AMD, the link is in the description. We will see you in the lab.